Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in the headquarters of our not only podcast studio, but my office here in Florence, Kentucky. Ez, what's up with you today, man?
Just like you, happy to be back in the bat cave of SWM, where all the tech and live streaming occurs.
Yeah,
all the advice, all the financial advising.
Damn good advice too. We're going to talk about that today.
Yeah, I'm proud to be wearing the flag today.
No doubt
of Shepherd Wealth Management.
So we're pumped. We're excited. Lots to talk about today.
Yeah.
And for those that are just catching the show for the first time, first of all, welcome to the show. Glad you're here. Please like, subscribe, hit that notification button on YouTube so you can get notified every time we do one of these, about every 2 weeks. But you can also go to shepherdwm.com. We're posting a Friday blog almost every freaking Friday. And the whole point of that is I'm summarizing the week that we just went through. Why did we go through that? What the performance was, and then ultimately what does history have to say about similar events, so you can kind of have a game plan going forward. And that's really kind of the overarching reason of all the things that we do here. This podcast, the monthly newsletters I send out to clients, and I post those monthly newsletters on the website, shepherdwm.com. The reason why we do all this stuff is because I know for sure that clients, prospects, everybody's catching the news. We're going to talk about some of these news, headlines here today.
Yeah.
And everybody's catching the news, and the news does a good job of, their job, which is basically making sure people are watching their programs all the time so they can sell ads. Well, how do you get people to watch the program? Well, you placate to human beings' most basic emotions, which is fear and greed. I've talked about this from day one of this program. I will continue to talk about it because it is the biggest hurdle, according to Warren Buffett, that the individual investor has is themselves. So you got to understand yourself a little bit, and the fact that we're all hardwired with these emotions called fear and greed. The news plays into that. I'm not knocking the news; it's their job.
I'm kind of knocking them for it. It'd be nice if there was a little more restraint.
When is the last time anybody in the history of the news was like, "Hey, look at all these babies that were born super healthy, and all these people that thought they had this terminal illness are now completely 100% healthy, and it was a medical miracle." You never hear about that. And if you do, it's maybe 2 minutes. Oh, how nice was that little joke? And then back to the world's coming to an end type of stuff.
Yeah, that's why I got a YouTube and see the puppies that get saved all the time, because I get so tired of the fear and greed that you say, is rampant.
It's just true, right? And if you can understand that, how do you get perspective, or how do you get control over those emotions? You have to go back and look at what history has to say. And that's really what we've done a great job of, I think, is showing people what does history have to say about a similar event in time. The only thing that was an anomaly that we don't have a precedent for was the global pandemic, right? We've never had a contagion that shut down the whole freaking world for as long as it got shut down.
Yeah, that's true. I mean, even the corollaries to the Spanish flu, in the early 19th century, we didn't have the globalization and interconnectivity. So the effects were very isolated.
I give you all that. Outside of the global pandemic crisis, we can go back and look at history and point to things that are actually going on very similarly right now.
Yeah.
And Warren Buffett said it famously, the one thing we know for sure about human beings is they do not learn from history.
Do not.
Now, here's the problem I have in this industry from a regulatory standpoint. All these compliance people, I love you guys. You have a very important role, and I'm not even joking about that, because there have been bad actors.
Yeah.
Which is the whole reason why compliance exists.
Into the camera now, so we don't get in trouble.
Absolutely. This is for you guys out there, state of Kentucky, Fed, etc.
Yeah, we love you.
It is a good thing to have compliance and regulations for all industries. We can debate on whether or not they're crossing lines, etc. That's not the point here. The point being is that we are required to tell people that past performance is no guarantee of future results. What I do not like about that, and maybe it's just me because I've been in this industry for so long and I've heard it so many times and I've had to say it so many times.
Yeah.
It really downplays the importance at looking at past historical events. Right? It's just one data point. It shouldn't be the only reason that we make a buy or sell hold decision.
Right.
But it is actually pretty damn important to look at what similar events in history would have to say so that you can actually say, okay, what's the market made of? It's made of a bunch of human beings. we haven't changed in over 2,000 plus years. So that's why it's super important. And we're going to go back and look at what we've said historically and given all the people in the audience here and current clients a look at what history had to say under similar circumstances, under a very stressful environment like 2022 was. Oh. And we happen to be very, very right. And I'm going to do a little victory lap today.
Yeah, okay.
Pretty happy about that.
Let's do it.
So I'm happy about the show. Very excited to get into this. That's why we do it. Obviously, if you can't tell, I love it. And before we get into that, as I think we got to talk about, with the viewers here real quick, we were wrong, at least 50% wrong on the NBA Finals.
Oh.
So we got the Nuggets right.
We did get the Nuggets right.
I can't believe they swept the Lakers, by the way. I was pulling for the Lakers the whole time.
I thought at least I was pulling for the Lakers too. Well, man. I mean, we talked about it. My four were going to be the Sixers, the Heat. I thought it was going to be Sixers, Celtics, Nuggets, and Lakers in the Final Four. And I had preferences, but I was going to be happy with any one of those teams winning. But man, with how close the Lakers came every game, like if you add up those whole 4 games, you take the point differential for the entire series. Mm-hmm. It wasn't even as bad as the last Miami Heat victory over the Celtics. Like they lost every game by like 4 points. They were in it to the end, and I just wanted them to get 1 or 2 for their own peace of mind going into next year. Because what a turnaround they had, Anyway, you're right.
Yeah, we got 50% right. I think the Heat got this one. Unless the Celtics can pull out a complete miracle, that's never happened in the history of the NBA.
Yeah, I wouldn't be surprised if the Celtics somehow win tonight, but I don't think they're going to. Within one of the next 2 games, I expect them to get knocked out.
So there you go, guys. We gave you a little bit of sports recap. Obviously, we're not professional sports anchors or gamblers or any of those types of things, but I feel like we had to talk about that real quick since we're on the precipice of the NBA Finals here. So
yeah, but if Malika Andrews is watching this and wants to give me a tryout for NBA pregame show, I'm here. So I have podcast experience.
That's right. Ez Kellerman, hit him up.
Yeah.
All right, so getting back to the show here. I don't even know how many minutes we're in here, Ez. So you got to keep me on point.
We're good. We're not even 8 in.
All right, sweet. So we got some pretty cool news that came out yesterday at 4:15-ish in the afternoon. I was obviously watching it because we are very large NVIDIA stock shareholders. So for those of you that do not know the name NVIDIA, it's a chip manufacturing company. Mm-hmm. And they are the largest chip manufacturer on the planet. They're almost $1 trillion market cap. It'll be the first $1 trillion chip company to become $1 trillion market cap.
Wow.
So they're just underneath that. Stock is up 25+% today on the back of their earnings announcements. So I just want to kind of hit the highlights here. Let's see. The semiconductor company reported April quarterly adjusted earnings per share of $1.09 compared with Wall Street estimates of 92 cents. So they beat on the bottom line. Revenue came in at $7.2 billion. Analysts were expecting $6.5 billion. However, gaming revenue, so gamers, I know that's you, Ez.
That's me, yeah.
Gaming revenue was down 38% from a year ago. However, sales for its data center segment, which is basically AI, was up 14% thanks to that artificial intelligence demand. But here's the big news for NVIDIA. So the markets are forward-looking. The people that are tasked with projecting what companies and what the overall market's going to do over the next quarter, year, et cetera, are called analysts. And analysts were expecting NVIDIA's revenue for next quarter to come in at $7.2 billion. So NVIDIA came out after their earnings announcement. Remember, they beat the top line revenue, smoked the bottom line revenue. And on top of that, this is the reason why the stock is up so much today, is analysts again expect the $7.2 billion for next quarter. NVIDIA's CEO, Jensen Huang, told analysts to expect about $11 billion, which is, according to my math, almost $4 billion more than what analysts had expected, 3.8.
Yeah, that tracks with my calculator as well.
Yeah, and we're only in Kentucky here, so somebody might need to fact check that one.
Yeah,
but
also bring us shoes.
That's right. We have our own bourbon, so don't worry about that. If you're guiding, if your forward guidance is 3.8 billion more than what analysts had expected you were going to sell during this next 3 months. That should justify the stock price moving the way that it did. So right now, again, it's up over 25%. I think it probably will finish the day around 30+%.
Oh, that's
just
nice.
in one day.
Yeah.
Now that is the biggest holding that we have here at Shepherd Wealth Management. It was not the biggest holding. It definitely was a large position for our customers, but we really added into tech at the beginning of the year. I'm going to come back to this. Again, I'm going to do a little victory lap here in just a little bit. But we made a nice decision early this year, late last year in December, where we rebalanced. So I'm going to talk about what we rebalanced from and where we went into it and why that was the exact opposite of what everybody else on TV and anybody in the financial newsletters that you might read. Everybody was basically saying the exact opposite of what we actually did. And that has nothing to do with me being the smartest person in the room. I am not. I'm not dumb. You can definitely say that about me, with my background, but I'm definitely not the smartest person in the room. What I am good at is I am good at looking at current information as it stands today, which everybody has access to. I don't have access to something that nobody else has access to. What I think we do a good job of is we look at what history has to say, and that's how we make decisions looking out 3, 6, 9, 12 months. And it's obviously worked out pretty well for our customers. But huge shout out to NVIDIA, Jensen Huang and the team. Essentially what they're calling for here is a productivity boom based on artificial intelligence. Now, I want to shift gears slightly by talking about something that I posted in January of this year. So it was our December newsletter. We post at the beginning of every month. So in this case, if we were talking about December 2022, I posted this at the beginning of January. So this is like the first week of January.
Okay.
So coming into this year, get to the top of this. So 2022, first of all, was the worst year since the great financial crisis of 2008. You saw the S&P down 20%. NASDAQ was down 33%. Small caps were down 22%. The overall bond market was down 14%. So it was a very dramatic year from a performance standpoint, specifically after the last 15 years when interest rates were zero. Everything was up and to the right after 2008, effectively. So what were the big reasons for the terrible results in 2022? So again, this is a newsletter that we wrote in January, or I wrote in January. So we're still dealing with the Federal Reserve tightening or increasing interest rates. We're still dealing with a war. We had zero COVID policy in China. That's now no longer a thing. Supply chain constraints, that's no longer much of a thing anymore. And there was a strong dollar last year. So those are the main reasons for that. Now, when we talked to investors through this newsletter, I had a very different perspective on what I thought the markets were going to do this year. And it had everything to do with what history had to say. So our number one sector coming into 2023 was technology. Our second favorite sector was industrials. And our third favorite sector is energy. Fourth would be healthcare. So why technology? Was that thing called a labor shortage? That demand drives automation. And this is something that we put a chart in the newsletter. I might repost this thing just so everybody can see it. Like, that was not the first time we've had a labor shortage in this country. You can go back over many, many decades, late 40s, parts of the 60s, 70s, even parts of the 80s and 90s, we've had a quote-unquote labor shortage. So what happened? Well, CEOs and CFOs, they do not wait for Congress to take action on whatever, immigration laws or some sort of incentive for people to go back to work.
God, no, we'd still be waiting.
Right? And you can't clone people yet, at least not legally.
Not legally.
Not on the corporate side. So what are you going to do? You have to spend money on investing in either a robotic or a piece of software that will automate that technology. And that ultimately hits the bottom line in a positive way for corporate profits, because that software doesn't need a holiday or a sick day or any of those types of things, health insurance, etc. That's how the technology sector. So if you break down the S&P 500, there's 11 sectors. Technology is the largest. That's 25% of the whole market. Just to put it into perspective for those that aren't familiar with this, healthcare is the second biggest sector at like 13%. So tech doubles the size of healthcare, which means tech dwarfs everything else. Well, if you go back in history, that was never the case. The biggest sector was always healthcare, followed by industrials, right? We were a huge industrial economy. That was the backbone of the economy post-World War II. Now, tech was a tiny sector back then. It's now the largest.
Yeah.
It's not by accident.
No.
So this is going to continue. This is going to repeat itself. History has a way of doing that. And it's actually more profitable for companies, and it's more effective and efficient for the economy because it frees up somebody to go do some other task that's more important for a company and therefore our overall productivity as a country. And that's the reason why technology was our number one favorite sector after I just told you that was the worst performing sector in 2022. Everybody was calling for the exact same playbook coming into 2023. Stay long energy, stay long healthcare. You're starting to get a better interest rate on bonds. So everybody's like, go buy bonds because we're going to go through a recession in 2023.
I remember that podcast. Ooh.
What in the, if everybody on TV, your favorite financial newsletter, whatever, all of them were calling for a recession, right? I can count on maybe 2 fingers the people that were not calling for a recession coming into this year. And maybe we get one, maybe we don't. But the reality is, if everybody thinks it's going to be a recession, including my 4-year-old daughter, it's probably a good idea to consider the alternative, right? Because that would be the most predicted recession in the history of mankind.
Yeah, and the inevitable thing was like, well, we all saw it coming. Why didn't we do anything about it?
That'd be the same thing as those that said, I saw interest rates going up 500 basis points, but I held on to my bonds anyway. Come on. Like, if you knew interest rates are going to go up that much, wouldn't you get out of bonds? Absolutely you would. And that's something that we talked about with clients at the very beginning of 2022. I didn't know they were going to go up 500 basis points, but the Fed did come out and tell you in December of 21 that they're going to increase rates. Well,
yeah, all gas, no brakes. They kind of made that statement,
When you increase rates, that's bad for bonds. So we got out of bonds.
Yeah.
And for those that wanted to hang on to bonds, at least they knew going into the year what was likely going to happen.
Right.
Same thing that we talked about with clients on the international side of investing. So everybody's like, specifically at those big places I used to work at, and you pick your favorite bank or your favorite financial institution. They're probably a great place to park money and make investing allocations. However, if you're getting your money professionally managed by those large outfits, they're always going to have a certain amount of your portfolio in international, regardless if you like it or not. And same thing on bonds, and same thing on the U.S. parts of the market. Well, we got at international because if rates are going up, and they're going up around the globe, right? Because there are other central bankers in Europe and Asia and South America and everywhere else. They're all saying they're going to increase rates. Well, those types of economies are older school types of economies. There's a lot of really old banks, a lot of really old healthcare facilities, and there's a lot of really old manufacturing facilities. There's very little technology in those types of countries, at least not relative to what we have going on here in the United States. So we got out of international at the beginning of 2022. That was also a really good decision. And all of this was the exact opposite of what everybody else was saying to do. They were saying stay overweight energy. Well, overweight means, if energy in the S&P 500 sector weighting is 5%, let's call it. Okay, great. If you're overweight, that means you have more than 5% in energy holdings within your portfolio, which we did in 2022. We were also overweight healthcare. Again, healthcare was 13%. We were probably around 20% in healthcare, and probably around 10% on average in energy in 2022. We were still, overweight in tech as well. So what did we do at the end of 2022, going into 2023? As I wrote this newsletter, I talked about we need to rebalance, right? The worst performing sector was the biggest sector of the market, technology. I just pointed out other similar points in time in history where tech had this major boom because of the investments that CEOs were making due to the quote unquote labor shortage. So we took our gains out of energy. We brought that back down to under 5%. We were like 2% coming into this year in energy. And we sold half of our healthcare holdings. So we went from like let's call it 20-ish% down to maybe 10 in healthcare. So we took all those gains, we plowed them into tech, which is our favorite sector here. And we also plowed some into industrials. And I'll talk about industrials here in a second. But that obviously has been by far and away the best performing sector this year. Tech is up like 20%, where the S&P 500 is only up about 8.5% year to date. Nobody, if you're just looking at headline news and just making all your decisions based on what you see in the headlines, you missed all of that. You missed 100% of it. Now, I still think that there's more room to go here from an energy standpoint, or I'm sorry, from a technology standpoint. I'll talk about that here last. But industrials. So why industrials? So again, we wrote about this in, I don't know, the last 2 or 3 newsletters. And I pointed industrials out as our second favorite sector here in this newsletter at the beginning of January of this year. So that PMI index, that manufacturing index, that hit its low point, or anything under 50 historically, going back to like the 1940s, anything under 50 on that metric basically signals a bottoming in industrials.
Yeah.
Which is great. You can't pick the exact bottom, but you know historically that that's a really good point to enter into industrials. It hasn't exactly played out perfectly year to date just yet from a performance standpoint. However, it should actually probably be the best performing sector right behind technology if history is going to repeat itself, because the 6-month forward average return under those circumstances is about 12.5%, going back to the 40s. And the 12-month forward return for industrials under these same circumstances based on history is about 21.5%. So I'm banking on that to actually play itself out as well, just as technology has. And we're underweight healthcare still. So our biggest favorite subsector within healthcare is biotech. Biotech has done absolutely great. And the reason why it's still working, even though other parts of healthcare are not, is it doesn't really matter if we have a recession or if we have, sticky inflation, which some people still seem to think we have. I don't. It doesn't really matter, because you still are going to make those investments into coming out with some other weight loss drug, which is a big theme going on right now in the healthcare space. Or, there's an Alzheimer's drug that's getting really strong results that Eli Lilly, I think, came out with. So
I did see an article with.
They're going to keep making those investments regardless.
Right.
Because the upside's huge.
Well, and everybody wants people to be better and healthy. I mean,
right.
Like not only is there huge profits in it, but that's just benefiting humankind.
For sure.
So
those are our favorite sectors. I wrote about this at the beginning of the year. Nobody wanted anything to do with technology.
Right.
Nobody. Everybody wanted a lot of energy. That's been a terrible performing sector year to date. We've gotten most recently more into energy, taking some profits from tech actually, and applying it to energy here recently. Why? Is because history would tell you that between May through the summer months is going to be a strong demand for oil. It's obvious. People want to go travel, go places, fly.
At least here in the U.S.
Yeah, and if you look at, all the airlines, they're booked.
Yeah.
Prices for a ticket. I mean, if you want to talk about sticky inflation, that's the only place where I see super sticky inflation. Go take a flight somewhere and tell me how much more you paid this year than the last.
Oh, I'm about to, and I'll let you know.
I can already tell you, because I've already been on some flights, and I'm like, man, you need like a small loan just to take a trip to Charlotte from Cincinnati.
My homie's getting married at a destination wedding, and I'm kind of nervous if I'm going to be able to get out there or not.
Yeah, and driving's no fun.
Yeah.
At least for me anyway. But so that's something that we've done. We will continue to put out all of this information. Go to shepherdwm.com on a weekly basis. I'm going to give you the data that I got. On a monthly basis, I'm posting the newsletter there. You're going to get all of the data that we have and our perspective on what's going on and why, and based on what history has to say, here's what we're actually going to do.
Yeah.
Right? We have all of this in writing. You did not have to take my word for it. You can go to shepherdwm.com and either read it or go watch a YouTube podcast that we've done about all the same topics. So a little pat on the back, and it was well-deserved, because 2022 was a real pain because we were still looking at things in a completely different lens than what the headline was. And we were doing better than the overall market, but it was still no fun to come in and say, hey, we beat the market, but we're still down.
Yeah.
Now we're beating the market in a positive manner, and we're actually slapping the S&P around from a performance standpoint, at least year to date here. So we got to talk about what to do next, because that's not going to continue itself forever. But before we even talk about that, I think we have to get into this debt ceiling type of conversation. I know we don't like to talk about anything related to the White House, but
or Congress
for that matter. But it is a topic of conversation here these days. I don't know if you guys knew about this or not, but the United States government may or may not run out of money on June 1st, which today is what? 25th?
25th.
How many days we got in May here?
Not enough. 30?
All right.
No, 31.
31. So if we got 31 days in May,
And
we got 1, 2, 3, 4 actual business days and 6 days if you count the weekend, which I don't think any of those guys are working on the weekend.
No, they don't work ever, much less the weekend.
Yeah.
So
I don't know. What do you think, Ez? I mean, I have my perspective on this, and I have some notes on what history would have to say here, but I'd be curious to see or hear what your thoughts are about this whole situation here. It's basically a big game of chicken.
Yeah, it's a big game of chicken if you know that there is no chicken.
There you go.
You know?
Yeah.
It's like, for me, I see it as, okay, is spending out of control? That's a different argument, but that's not one that's exclusive to whoever's in the White House now, right? My entire adult life, it seems like every 2 years somebody tries to squeak about the debt ceiling, but they raise it anyway. No one does anything about it. It doesn't matter if it was Bush 1, Obama, Trump, or now Biden, right?
Yeah.
So to me, all it is it seems like somebody in a new job is trying to like play strongman and act like they can get some results when we all know what's going to happen.
Yeah.
The debt ceiling is going to get raised one way or the other. Either Congress is going to cave and just be like, cool, we were going to do this anyway, or Biden's going to do it on his own, which he clearly seemed to think he has the power to.
So I got 2 thoughts on this. Number one,
It's going to happen at the last minute.
Self-preservation is a major, powerful driver.
Yeah.
Right. So self-preservation on both sides is huge. I don't think anybody wants that blood on their hands.
No, I mean, it's completely, it seemed to me like it would be just like career and political suicide,
right?
To just like shut the country down to try to prove some point. Not because it's really, I'm sorry. Like I know we don't want to talk politics here, and I'm certainly not trying to make it a partisan issue because I don't like anyone on either side of this.
Well, this is dumb. And the reason why I call it a game
totally
of chicken,
dumb.
it's political posturing. I think the whole market knows it. And I don't think the market's pricing in a default. I do think it is putting a cap on where I think the market probably would be here today. Probably would have already been to a certain spot as far as getting past that threshold of 4,200 on the S&P 500. That was something that we did pass a few days ago, intraday, but we never closed above 4,200. I think the S&P would be rallying pretty strongly based on the excellent earnings season that we just got through here. And, jobs numbers came in lower, claims came in lower. Unemployment claims came in lower than analysts' expectations were today. So the job market's extremely resilient. We're going to get another inflation reading, that producers' inflation reading tomorrow, core PCE.
Yeah.
But, so self-preservation is a big driver for why I think the debt ceiling was ultimately going to be raised. History would have to say that the debt ceiling is going to get raised. It's going to take till the last second, basically because people on either side of the political aisle want to say that they've fought it till the last second to squeak in whatever it was that was important to them and their constituents. And it's just unfortunate for the overall economy that we're basically the world's default currency.
Yes.
And the largest economy on the planet. And we got to do this stupid game of chicken, it seems like every couple of years, to your point is.
Yeah, it's completely manufactured. Well, and, we didn't go through this when Trump was in office because everybody knew it was going to get raised anyway. People, like the politicians, they don't actually care about the debt ceiling. It's a completely manufactured issue for some saber rattling and this chicken to score points with viewers and voters. And I can't stand it either because
I just want them to run it like a business. Like, okay, if you were a business, public or private, and you have more liabilities than assets, if you have less revenue than expenses, what are you going to do? There's only so much on that expense side of it that you can control and just eliminate. How about try to raise more money without freaking everybody out from a tax standpoint? There are so many ways for a municipality, for the federal government to drive extra revenue through sales tax, something along those lines. That would actually put us in a surplus. How about try to get to a surplus as opposed to trying to have a less of a deficit?
Yeah. And I mean, the easiest thing to do is to make sure everybody pays their share, because they don't.
I'm down with all that, but the biggest, the reason why I don't know if we'll ever solve that problem is just because there's so many, like, for example, I'm not knocking this because I am a landlord. I do like investing in rental properties for so many reasons, and taxes are one of them, but everybody in Congress owns real estate. I mean, if you look at them all, they all own rental properties to some degree or another, some a lot more than others. But I just don't think that there'll be enough of those loopholes plugged, if you will. So I don't know if that's necessarily going to be the quickest fix, but to me, if I'm running the largest economy on the planet, the default currency, number one, I want to show leadership and not wait till the last second to get what everybody knows is going to get done. And number two, I think everybody would be behind either aisle, right? I think you could actually run on this whole idea of, if we're the default currency and we're the largest economy, why in the hell are we always getting a bigger and bigger deficit? I mean, between just the Trump administration and the Biden administration so far, obviously you still got another year to go here, year and a half at least. We went from $20 trillion in the federal deficit to now $31 trillion.
Yeah, that's
not even 6 years, or it's like, what, 6 years, something like that?
7 years? It's 6 years.
That's nuts. Like, you literally increased it by like 55, 60% of the deficit in that. Now, granted, we had a global pandemic that definitely, was a big fuel to that fire.
Sure. But nobody was screaming about the debt ceiling, like for your, your point, like last administration when it was going skyrocketing, nobody cared.
Honestly,
it's just political chicken right now.
It is.
That's all it is.
Just raise the damn thing and actually come out and show some leadership and not worry about, we're going to cut this expense. Yeah, we need to be more fiscally responsible. We probably don't need to spend as much money as we're spending on, pick your topic on what we spend money on from a federal standpoint. But I think the long-term solution is you got to look at it like a business owner, and you cannot run a business indefinitely for the end of time when you have more expenses than revenue. It just does not work. And it will not work long term. I'm thinking more for my kids and hopefully future grandkids of mine that I'll have. But we'll see. We'll see how it all shakes out here. So that debt ceiling is obviously putting a cap on the market, and it's still the number one reason why there is more cash sitting on the sidelines, not just necessarily on the retail side. The retail is the do-it-yourself investor, the person that sets up an account at Fidelity on a Tuesday and decides to start funding it, on a Wednesday, and buying shares.
Over here, Monday night, buy some Bitcoin.
That's right. Maybe not Bitcoin for me, but every Monday I do put money in and I buy. It's my way of dollar cost averaging and automated savings, which is a great idea. But this whole debt ceiling thing is certainly from the institutional investor. Now, these are the hedge funds. These are the people running pensions. Massive. I mean, this is by far and away the biggest part of the stock market. And there are more dollars in cash, money markets, treasury bills, or cash equivalent vehicles for institutional investors than even during the great financial crisis of 2008.
Wow.
Now, obviously, they missed the majority of the run-up in tech and the performance in the overall market relative to the 5% that they were guaranteed, let's say in a treasury or even a money market mutual funds. If you're getting a money market mutual fund at 5%, that's awesome, but you got to keep that money in there for the entire 12-month calendar year to actually recognize that full 5%. Whereas NVIDIA is up 25% in one day, right? So there's a huge opportunity cost for those that feel like, I'm going to be smart and I'm going to go with the overall crowd here, the cynical crowd, that we're going to go through a recession and this is going to be inevitably, a really difficult back half of the year. Who knows? The only way that we run into a recession at this point is if the Fed causes one.
Yeah.
Because you're just not going to have one. When you got GDP as strong as it has been, which was revised this morning, by the way, from the last GDP report, going up. It was 1.1, now it's 1.3. Again, everybody that's losing a job is finding one, it seems like, based on the data that we continue to get, every single week from a job standpoint.
Yeah. I mean, if you end up firing me, I'm just going to go work for OnlyFans.
Dude, I know. I mean,
right?
I can get a job
so
anytime I want to, and so can everybody else that's out there looking for one, except for maybe those very high-end, expensive software engineers that, Facebook doesn't need you guys, at least for a couple quarters anyway, it seems like. But that's what's going on. The labor market is so tight. We're so productive as an economy. In the face of all this negative sentiment, 500 basis points worth of increasing interest rates. Everybody was calling for this earnings recession that never flipping happened. And we talked about historically, the market has almost never had 2 consecutive negative years. It's happened a few times, 3 times. To be exact, over the last 50, 60 years. So we talked about that in the most recent newsletter that we've sent out to clients. We can go on and on, but the point is that I think the biggest issue that individual investors have is they get sucked into whatever the headline news is. And I can verify it. I talked about this a couple of weeks ago. I got invited to speak in front of a nonprofit organization, and the people that were charged with running this nonprofit, they're all business owners here in the community of Cincinnati, smart people, wide variety of industries that they're operating in, and some are very large, some are small, some right in the middle there. And I just asked everybody. I had a 45-minute presentation ready to go, and I said, hey, before I get into my agenda. You guys are all smart, successful business people in the community, been doing this a long time. I'm sure you all watch the news, everybody's shaking their head.
Yeah.
And I was like, based on what you're seeing, headline news that I see is, inflation's sticky. We got war going on, supply chain problems. We got a debt ceiling thing we got to deal with here. I'm like, how many of you think the market's down at least 5% year to date? And I'm asking this question in, May? So this is like early May. Everybody's hands shot up. And obviously I baited these people because I already knew what the answer was to the question. Well, actually the market's up 8% year to date in the S&P, and the NASDAQ's up close to like 17% at that time. Now it's actually worth more. And I got everybody's attention right then and there. And that's the whole reason why we do this show, is because I know that that's true for everybody out there watching this.
Yeah, that's not an individual number just for that meeting. That's the reality.
I know. I wish I would have caught that on camera. I don't know. I'll have to keep a GoPro on me for the next time, I guess. But everybody, I got their attention immediately, once I said all that. And we were able to get into basically a short version of what we do here every 2 weeks, which is telling people what's going on and why, and giving actual historical precedents of similar events so that you can actually make some intelligent decisions. Because if the market's made up of human beings tend to not learn from history, as Warren Buffett famously said. And we get to take advantage of that, which is awesome for those of us that pay attention. So a little bit of a pat on the back again today. Now, the last thing I wanted to get into is this Fed minutes that we finally got to take a look at yesterday.
We need to get the, what's that Law and Order soundbite? Dum, dum, dum.
Yeah. Man, I wish they could, if you could sell tickets to get into this Fed meeting, I would pay for it.
Oh, we'd tailgate.
Oh, yeah.
Big time.
Yeah. I definitely would. I obviously need to come in there, clear-headed. So it would be more like, I don't even, like a child's birthday party kind of tailgate versus like, I'm going to go watch the Bengals beat up on the Chiefs.
Yeah, instead of that, we definitely don't want to do NFL-style tailgating. But, we'd probably be crushing energy drinks and doing push-ups in the parking lot, maybe pounding some donuts.
Absolutely.
Maybe an omelet bar instead of a grill.
There you go. I'm a big brunch fan, by the way.
Oh, yeah. You've got a pulse, don't you?
Oh, yeah. If anybody's out there that wants to give me something for just because we do this show.
Yeah.
I'll take a gift card to Taste of Belgium.
Ooh, you like that place, huh?
I'm a fan.
Nice.
I'm a fan. All right. So back to these Fed minutes. So the minutes, this is May 2nd and 3rd. that the officials remain focused on reining in, quote, unacceptably high inflation. They are balancing the need to rein in price growth and growing likelihood that fallout from recent bank failures would have a dampening impact on economic growth. Participants generally express uncertainty about how much more public tightening may be appropriate. Basically, if I continue to read all this, they don't know what to do. So that's a nice...
that's a bow put on it, right?
Yeah, that's a nice... Somebody edited this. So it was like, basically what you guys are saying, I don't know what to do. Let me figure out a compelling and cool way of saying the same thing.
So do you think they'll just finally look at data and pause at least, take a beat here?
So we wrote about that and did a podcast specifically titled "Not So Data Dependent." I think that was like last September or October, something like that.
I mean, that was kind of the theme for the last Q4 of last year, was that they just seemed to throw all that out the window.
Yeah,
and Q1 of this year too, as they continue to just all gas, no brakes.
Bank failures. What are we going to do? Let's tighten the rates.
What have we been doing?
And that's just another risk in and of itself with the Fed. When everybody at the Fed saying the same thing, probably not a great idea. Well, at least these minutes from early May, again, they raised rates, right, a couple weeks ago.
Yeah, back in April.
They decided to do it. I thought it was dumb. I thought the interest rate hike in March was also dumb. But they did it anyway, even post-bank failures. And these minutes are encouraging in the sense that there's at least a few people in the room. I don't know if it's 50% of them yet. It doesn't seem like it to me. But there's growing number of people that are looking at this and saying, damn, we did break a few banks.
They did.
We have to consider the fact that we've only been increasing rates for a little over a year now. There is this lag effect that we keep talking about, even though it's not showing up in the housing data yet, and it's not showing up in the jobs data at all. But we do know there's a lag effect that we have to account for. And there were some people in the Fed room, based on the minutes, that didn't necessarily want to raise rates, according to this, because they knew that there would be some credit tightening, right, with the bank failures that have happened. Like, who's out there hitting up a bank for a loan right now? Probably hardly anybody. And obviously, when there's less loans, there's less money in the economy, which means things are tighter from a fiscal standpoint. So that's the reason why there are at least a few people in the room that think we don't need to increase rates coming up here in June. So the next meeting is June 13th and 14th. I think the announcement's going to be on the 14th of June, which again is just a couple weeks after hopefully we've raised the debt ceiling. So literally this entire year, this has been the most hated 20+% bull market rally in the history of rallies.
Yeah, it has.
And I've called for a 10+% year going back to last year, which nobody believed. I guess you can believe it now because you have no choice to believe it.
Well, we still got to get to December.
But
it's looking good for you now. That's
looking really good. And, we'll see what actually happens here in June. But literally every single month this year, we got off to a rocket start in January and February. And then all of a sudden we break some banks in March. Market kind of freaks out. Yeah. Earnings keep being good. We'll see what actually ends up happening here by the end of the year. But it feels like there's always a wall of worry that people in the market have to overcome. And I think there's only two left. You got the debt ceiling, which the market,
way or the other,
that's getting raised, baby.
Yeah, or one way or the other, we're going to find out in 6 days.
Yeah. And the other thing is going to be what happens on June 13th and 14th. If we don't have a debacle with this debt ceiling problem, so if they raise that like they historically always do, you'll see the markets pop and you'll see them chill out. It'll probably chill out right around that 4,200 number on the S&P 500. I hope it exceeds it and closes above it. That'd be great. Then you're probably going to find resistance on the S&P 500 around 4,300 or so. But going into that Fed meeting, if the Fed makes the right decision to pause, they can be as hawkish as they want to be. They can say, hey, we're not going to increase rates because of credit tightening and the lag effect, and inflation has been falling for 10 straight consecutive months. It's going in the right direction. We'd like to see it go there faster.
Yeah.
But because of those things, we are not going to increase rates here in our June meeting. We will continue to be data dependent if inflation continues to be too sticky or rise, because it hasn't risen, right, since last June, July, something like that. It's been almost a year of inflation coming downwards. So they have all the cover in the world to go ahead and say, hey, we're going to pause and take a pulse of the economy and see what happens here over the next month. And if we have to, if inflation rears its ugly head again, we'll come back to the table with our monetary policy tools and we'll increase interest rates. The market will rally on that. It will rally on that. And probably what we're going to do here at Shepherd Wealth Management, because I believe the debt ceiling will get raised before June 1st or, the night of May 31st. You'll see the market rally. In anticipation of that, I don't know for sure what the Fed's going to do because I didn't think they needed to raise rates the last 2 times they did it, but they did it anyway.
Yeah. I'm
probably going to take some gains from tech. I'm going to take that money. I'm going to park them in a money market that's going to get us about 4.9%. That's available immediately. And then I'm going to allow that Fed meeting to happen. And if the market sells off, I'll have the liquidity to go buy more shares. If the market pops up, I'll make a decision at that point in time whether I want to add to places we might be underweight, like healthcare. We're overweight industrials. We're already overweight energy, so I don't know if we'll add more to that. But I'll either be adding to something a little bit more defensive like healthcare, or I might park it in a money market for 3 months because we're already going to be overweight tech. We're overweight energy going into the summer months. We're overweight industrials because of all the reasons I just laid out here. And we might add a little bit to healthcare, but more likely a lot of that money will go to short-term treasuries. We'll wait out, the summer months, unfortunately, because everybody's on vacation mode and not paying too much attention to the markets, generally lower volumes, generally not a lot of things are happening. It's not to say that you won't have a strong performing summer. We'll be in a position to benefit from that if that actually happens. But, we might take 10% of profits and, hang them out in a short-term money market because we're getting close to 5% in interest there. So that's the game plan. And this all based on historical data here, folks. You're not going to get this stuff from the news. We try to do this every 2 weeks and give you our perspective. We'll back it up with data. We'll share all the historical evidence that we have. And we'll actually give you some ideas to what we're actually doing for clients. I'm not going to give you the individual weightings. And I'm sure as hell not going to talk about performance as much as I'd like to, just because I don't want to get in trouble by any regulators.
Yeah. Which are important and we love you.
Yeah, absolutely. A lot of fun. I hope this is helpful. Hopefully you guys can look at this information and make wise adjustments with the portfolio, not just what you see in the headline news, but take a look at what history has to say about similar events before you just take their word for it. If not, just tune into our show. We'll be doing this again about every 2 weeks. You can go to shepherdwm.com. You can check out all the newsletters, all the blogs, all the historical video evidence from these podcasts. So you don't have to take my word for it here today. You can actually go back and check it out yourself. As any wrap-up words here?
Yeah, I just want to remind all the people watching and listening that if you see these episodes in the future and you have any questions about the content, please drop a question in the comment section. Also, we do take questions via chat and text messages during our live stream. So if you have anything you want to ask Joshua about or anybody else on the SWM team, please go ahead and fire them off. We love it.
So. Absolutely. Well, we'll do this again. It's a pleasure. Hope you guys have a great rest of your day and enjoy your Memorial Day weekend. I'm looking forward to that as well. Take care.